share with us from Fund 1 to now Fund 4, how you structure your fund and the amount that you raise for each fund has changed as you grew your business?
Yeah, our first fund was a $10 million equity offering, so relatively small. Your first fund is always challenging. You've got to go out there. You don't really have a brand or reputation at that per
Hmm.
track record. So it's really hustling hard, getting in front of people and asking for their trust. And I was lucky to meet some people that took a chance on me, and it paid off tremendously for them and for me, frankly. Our second fund was a $58 million equity offering. We started off as a $35 million equity offering, but because of our performance, it was oversubscribed. Fund three was a $100 million equity offering, but again, because of performance, it was oversubscribed by $40 million. So that was a $140 million raise. And now our fourth fund is a $200 million raise. And I could tell you, well, I have a lot of sponsors or new sponsors come to me and say, "Hey, what's your best advice on how to raise capital?" And my answer is very simple. It's do as you say you're going to do and perform. If you do those two things, you'll have no problem raising capital. And that's the position that we've been in here at Crystal View. So for us, delivering for our investors goes above and beyond everything else that we do. Because when we go out to launch a new fund, our investors know us, they like us, they trust us, and they know what kind of returns they could expect.
That's really good. In the multifamily space, a lot of sponsors have had a lot of challenging deals, especially when they bought in within like around 2021, 22 timeframe. How have your deals been and how have your fund, like in especially in your market? I guess two-part question. How has the self-storage and multifamily, self-storage and mobile home parks markets been during those peaks times? And then how has your fund been
Yeah.
doing? Any challenging deals on your
There,
end?
every deal has not worked out exactly as planned, but I will tell you this, that on the whole, the fund is actually performed, all of our funds for that
Mm.
matter, are performing ahead of projections from when we
Oh, that's
launched the
great.
vehicle. There will be a deal, you do enough deals, there's going to be a deal or two that doesn't work out per your initial underwriting projections. But I'll tell you this, our balance sheet is very conservative, Tim. Our leverage right now in Fund 4 is like 25%. In
Oh,
Fund
wow.
3, it's 50% or less.
Oh, wow.
And the
Okay.
reason why we've struck, and we have really no debt that's coming due. Most of our debt is fixed in place right now. So we're in a very strong capital position where we could weather almost any storm. And the reason why we set it up that way is we'd certainly rather be overly conservative rather than overly risky to hit a certain return profile. I'll also say this, we haven't skipped a beat on distributions. We've never missed a distribution in our funds, despite the movement in interest rates, where a lot of sponsors, a lot of our peers and competitors, they've cut distributions or they've frozen them entirely. And the reason I
Yep.
know this is a lot of our investors are invested in other sponsors in our space. And I think the reason for that is overly optimistic underwriting assumptions, buying into assets with variable rate debt with the idea that you're going to grow NOI. And when that didn't materialize, and when interest rates ballooned, you're like in a position where you're going to lose the asset now. So very unfavorable. We're actually looking at some of those deals as a potential buyer right now. It comes back to being a prudent operator, being a disciplined acquirer. If you know how to do those things right, you're probably not going to get hurt, or you mitigate your risk of getting hurt tremendously. And I will just end with this on your question. These two asset classes, fundamentally, I haven't seen skip a beat either. So despite
Mm.
the challenging interest rate environment, we're not seeing operational distress out there. It's not as though delinquency is through the roof, tenants stop paying their rent, there's a huge fall off in occupancy. I'm seeing some softening on the storage side, which is actually starting to stabilize a bit. But I'll be honest, COVID was very explosive for storage.
Yep.
Occupancies went through the roof, revenue growth went through the roof, and that's definitely tapered off. And we're back to a more normalized environment on the storage side, but the manufactured housing continues to grow by high single digit, low double digit revenue growth per year. So these two property types, we're seeing very little or no operational distress.
I see. That's good to know. Do you pay out quarterly or monthly?
Quarterly, and we're already hitting a full district. Fund 4, which was launched in 2023, I'm very proud of because, again, we're ahead of projections. We're already hitting a full preferred distribution, which ranges from 7 to 9.5%, depending on the respective unit class. And we've made all of those distributions in that short amount of time in a 2-year ramp period. So really proud of those results and our team's ability to execute, add value to assets so we can make those distributions to our partners.
I see. Okay. In terms of the equity that you raise in your fund, what would you say is the percentage that are like family office type of investors, percentage that are other fund of funds managers? A lot of people on this call are actually they do fund of funds.
Okay.
And then what's the percentage that are your retail investors?
Yeah, great question. So let's break that down a bit. We have several family offices. I would say they fall on the smaller side. Let's say $500 million to $1 billion net worth in that range. I would say you're looking at probably 20-25% of our LP equity is comprised of that. Then you've got probably another, and don't quote me on this, 20-25% fund of funds. Got a lot of those groups, some of them larger, some of them relatively newer that are just starting out. We love to work with
Mhm.
fund of funds. And then probably 50% are just your retail investors, whether they're part of an investor group like Hero or there's various others out there, or if they're just a kind of a one-off investor. I will say this, I think it's important to notate probably 5 to 10% of our limited partners are former sellers. And the reason why I think that's important is it speaks very highly
Wow.
of how we operate as a deal partner. We tell sellers the truth. We create win-win scenarios for them. We do what we're going to say. We don't retrade unless there's something material that takes place during that transaction that wasn't disclosed to us. As a result of that honest dealing, once we close a deal, a lot of sellers come back to us and say, hey, I had this great liquidity event. I don't know where to put my capital. You did exactly what you said you were going to do. I got to learn a little bit about you during the transaction. I got to learn about your company and the returns that you deliver. I'd like to turn around and write you a check back. Is that okay? So we see a lot of that take place. And then finally, last but not least, I put a lot of my own money in these deals, Tim, as a limited partner. And I don't get any preferential treatment. I invest on the
Mm.
same terms that you would or anyone on this call would, for that matter. And I do that because I think it creates a very strong bond and an alignment of interest and trust. And secondly, to be honest with you, I don't, for selfish reasons, I don't know where I could get a better risk adjusted return.
That's good. Hey, betting on yourself. That's
That's what
amazing.
it's all about.
Yeah. So with it being a fund structure, especially those sellers that have a liquidation event, are they able to 1031 into your fund somehow?
Great question. They can't 1031 into the fund. Again, let me back up first. I'm not a tax advisor, I'm not a CPA. So I want to put that disclaimer out there. With the knowledge that I have, the answer to that question is no, because a 1031 exchange is like kind. So it'd have to be real property. A LP position in the fund is considered a security. So you can't swap real property for a security. But here's what you can do. And here's what a lot of sellers have astutely done with us. There is another known section of the IRS code that's lesser known, that's very similar, that's section 721. And think about it this way, it's like a stock swap. So you're an owner of a mobile home park, easy math. We both agree that it's worth $1 million. I come to you, Tim, and say, hey, I'd like to offer you $1 million. And you come to me and say, this is very tax inefficient for me. I don't know where to put my money. And I'll say, hey, within section 721, I'll issue you $1 million of stock in Crystal View Capital Fund 4 in exchange for the asset. So we would own the
Mm,
asset within Fund 4. You would own still a piece of that asset by virtue of being a fund LP, along with the other 22 investments that are part of the portfolio. And that's completely tax deferred, just like a 1031 exchange. So you would alleviate yourself of the day-to-day management responsibilities. You'd start generating that 7 to 9.5% cash on cash return, and you'd own a piece of all the deals within the fund.
wow, that's really good. That's my first time of hearing that. So good to know. I
Yes.
learned something new. What was that code? Section what?
If you want some information on that, there's actually a website we've created called cvcequityswap.com. And Ben can provide you, we have some literature on how this works. But if you go to cvcequityswap.com, we created a neat cartoon that explains in detail on how this process works.
Yes, we like cartoons. Make it easy for us to understand. All right.
Absolutely.
Yeah, let's switch gear and talk a bit about capital raising. And obviously, you have had a lot of experience in raising capital, just between not counting the deals you've done before you started Fund One, but yeah, just in Fund One to Fund Four now, you already have a few $100 million raised. And so, share with us your top three channels or ways of raising capital that has proven to work very well for you.
Yeah, look, it's been a variety of sources where it's worked for us. My team has come to me recently. This one actually surprised me a little bit. I've never been a fan of being a public figure. I never really had a Facebook account. I was never on social media, didn't really even understand it, just private by nature, my family and I. But my team has come to me and said, look, you're really missing an opportunity to raise capital and grow the fund unless you go out there in social media, and we'll do it for you. We'll create the content. We just need you to be the voice and the face. When you go out to an asset, you do your due diligence, talk about it, make a short video. When we acquire an asset, tell the audience what you liked about it, why you bought it, what the value add initiatives are there that we could execute upon. And I gave it a shot and it actually worked quite well, Tim. So social media has been a source for us that conveys the message and the theme and the culture of Crystal View out to the broader audience. And I actually have enjoyed that process. And a lot of people have come to us and said, hey, I've been inspired by your message. And for me, that makes it all worth it. So that's been a pretty big source for us. A lot of repeat investors. We still have our Fund One investors that come back to us and re-up in Fund Four. They're in Fund Two and Fund Three and now in Fund Four. A lot of these fund of funds continually come back. Again, I said this before, I'll say it again. It's all about the best marketing you could do is deliver for your investors and do
Yeah.
what you say you're going to do. If you do
Yeah.
that, the capital is going to come. So it's through referrals, it's through repeat, and now I would say social media is the third source.